and thank you for being with me this evening. And David, you are an absolute treasure. Thank you for that. Let me know that you can hear me and see the screen. So all is going well so far. Well, I've been absent from duty for a few days, but in fact, I've been on very restricted duty for quite a sight longer than that. And all of you here, all of our usual regulars are here. I thank you so much for your support. And so many of you wrote to me wishing me well with the cataract surgery I had, which is pretty minor surgery normally, but it's a bit complicated with another issue I had, which involves some much deeper surgery into the eyeball. Not nice, any of it. And of course, as you get older, Greg's here with us, so is Jack and Jeff and John, and everyone's here. Justin, grand to have you, Justin. So generous with your help to all of the Danielcode people. Mark L is with us, Norbert's with us, Peter Mack, who's not a day trader, is with us. Pietro, I haven't seen you for a while. Good to have you with us, my friend. Steve's with us. Wonderful. Vicky's with us. Thank you so much for being with us today, Vicky. And we've got many others. Brandon, you're on the having a break from school, are you, mate? Wonderful to have you with us. Thank you. Let me see what else I can see. And the answer to that question is not a lot. Excuse me, Greg. Greg, the other Greg is with us. Greg Palladini is with us, and the other Greg, who's a wealth manager, super trader, all around very decent person who I like a lot, and looking forward to meeting you again, Greg, in the not too different future. And a Gig, of course, is with us from North Carolina, and many others. Thank you, all of you, for your support. A special thank you to those who wrote to me wishing me well for part one of the surgery. It's, as I say, a fairly basic, very popular procedure, which attracts many people in their older years. And the issue with me has been slightly more complex than that. And here we are at about 2 weeks, in fact, exactly 2 weeks since I had the first round of that surgery, and I'm having serious difficulties with my eyesight, and hopefully it's all going to get better with a bit of time. And the next procedure to do the other eye is the 6th of March. And I hope things will be a whole lot better since then. So let's move on, because markets have been doing their thing, roaring along. And I think there are a couple of insights today that are going to be really interesting to you. Greg, they're coming, mate. They're on the way. You just hope they're not. Okay. Anyway, it's I think these things happen. So I've titled this webinar "Trade the Mania," and of course I thought up this webinar a few weeks ago when we had gold and silver going parabolic, and certainly really in the grip of a mania. And what are the conditions of that mania? Well, it's a strange thing that overcomes traders, that they get to the stage they are completely convinced that markets only ever go up. They are also convinced that the asset they're buying at this elevated price is good value. And of course, it's not. All markets are mean reverting to some degree or another. So we've seen gold and silver both make their highs pretty much exactly at the Danielcode targets. So what mania am I talking about? Well, Dow's just made a new all-time high on the 18th of February. Australia's share price index makes a new all-time high this week. And if any of you take an interest in Australia's economy and governance, and I don't see any reason why many of you would, unless you live here, I can tell you the concept of the share price index making a new all-time high is quite frankly hilarious. The Australian economy is a mess. The Labor government in Australia, who were re-elected 2 years ago with a record representation in the Houses of Parliament, they are totally hopeless, haven't got a clue. And let me tell you how much hope one can expand for things to get better in Australia. Our treasurer is a gentleman called Jim Chalmers. And Jim got the job as treasurer because he has a PhD. And let me tell you that PhDs in the Labor ranks are very rare. Labor essentially is the representative, what we call the Labor Party, you'd call the Democrat Party in the States, or the Labor Party in UK, same thing. They are creatures of the trade union, and these folks tend to come up from the trade union and through various representative bodies of the trade unions. Rarely has anyone made the statement that they are overburdened with brains, but our treasurer, arguably the most important job in government from an economic point of view, he's got a PhD. What makes it interesting is if you realize that he got a PhD from the arts faculty. And a PhD from the arts faculty, I'll give you an example. There was a recent guy got a PhD at a ceremony I was attending with another hat on, and his PhD was on the run scoring tempo in international cricket games. Now, I know you'll think I'm kidding, I'm not. However, that also came from the arts faculty. And Mr. Chalmers' dissertation for his doctorate was an analysis of the life and times of a previous Labour Party politician who was also a Prime Minister. Can you think of anything more incestuous than one Labour Party politician writing a thesis on another Labour Party politician? I mean, I won't say that PhDs come in your cornflakes packets these days, although honestly, some of them, including in America, they certainly make you scratch your head and wonder. So the chances of Mr. Chalmers having some deep and outstanding knowledge of how economies work are pretty close to zero, and he's managing to display that in spades by what happens with all Labour parties, and they often want to brand themselves as New Labour. And I can tell you from many years' observation of Labour parties around the world, New Labour is exactly the same as Old Labour. And they're always at the business of taxing, tax, and spend you have no idea. I think Australia is very close to a economic crisis. The leadership doesn't seem to have a clue. They just don't seem to really understand what makes markets go, and they'll be feeling happy with themselves, no doubt, as is the Trump administration when the US treasurer, the beautiful Pam Bondi, who I can tell you some years ago literally was very close to Miss World. She's a gorgeous, gorgeous lady when I met her some decades ago. It was a great privilege. Anyway, she says to most claims of government malfeasance, look at the Dow, look at the NASDAQ. Well, look indeed, because I think exciting things are going to happen, and it's not what everyone expects. So what else is happening in the mania world? South Korea's Kospi index is making new all-time highs. It was up 3% on Wednesday, one day. All US equities are hovering near their record highs, and credit creation is massive, and private credit is at all-time highs and expanding massively. And you've heard me talk recently about the issues of credit, of issues of debt, nations' debts, and Australia, like the US, is setting new records in all-time debt. And Sarah, welcome, Sarah. What do I think of Pauline Hanson? She's for those of you who don't know, the lovely Pauline who started life as a fish and chip shop proprietor before going into Parliament to represent the Australian people. She's a very outspoken person, very firm right-wing views. I think some limitations are that she's not terribly subtle. She keeps putting her foot in her mouth in the public spaces, and of course, as our media in Australia is predominantly left-wing, as it is in almost all countries in the world, they take a delight in taking the slightest misstatement and making it into a mountain. So I think she's a very interesting, and I've actually voted for her in the past a couple of times when I've been thoroughly and utterly disgruntled with the Liberal Party. And she represents a right-wing strand that's pretty much out there, but I think it's an important contribution to the debate because a bit like Trump, she says things that other people won't say. And a lot of that stuff needs to be said to have a balanced debate, which is pretty hard. So there you are, Sarah, that's my viewer. A breath of fresh air. Is she the answer to the non-Labor party? I don't think so, but I think she contributes to that. So let's get on and talk about what else is happening in the mania, because the biggest mania of all, as you know, is the AI debate, artificial intelligence, which I've given you my view of for several months now, so I won't repeat it. But the massive moves, the massive plans in store for the AI from the big mega companies are staggering. I've been telling you for 6 or 7 months the cost of these building and creating and managing these data banks are going to be so huge that it's worrying in terms of we're starting to get a picture of what the costs are likely to be. We don't yet know what the benefits are, apart from some very, very helpful tools from the large language models that do wonderful things for people who people are impressed with technology. I think this modern age is all about technology. People have been brought up seeing all the wonders of technology unfolding over the last many decades, and they accept it completely. I'm not of that era, so I'm a little bit more skeptical. But the fears about these recent announcements of the massive amounts of money, the additional Capex that the biggies, the Mag 7 minus Apple, are figuring to pour into the development of these infrastructure for artificial intelligence. There are two different views. One is that AI is poised to disrupt entire segments of the economy so dramatically that investors are dumping the stocks of any company seen at the slightest risk of being displaced by the technology. And if you don't follow the stock market closely, you probably don't know that the last period has seen massive dumping of stocks that are, let me find the right word, stocks that are vulnerable to AI, particularly software stocks. So the argument is framed as semis or semiconductor stocks or companies based with semiconductor assets versus software. and the software sector has been taking an awful bashing, and down, down, down. So the other view is a deep skepticism that the hundreds of billions of dollars that tech giants like Amazon, Meta, Microsoft, and Alphabet are pouring into AI every year will deliver big payoffs anytime soon. And there's considerable skepticism about that. And as one of the commentators says quite rightly, there is a contradiction when it comes to what investors are worried about when it comes to AI. The North Asian Chief Investment Officer of Nomura, their wealth management team, told Bloomberg Television, those two things can't be true at the same time. Well, there are many things in the stock market that can't be true at the same time, but sometimes they hobble along. Sometimes they manage for a while. Sometimes the great rotation, which has been going on in equity markets, can give the appearance of holding up all of the water, nothing too drastic leaking out. And you have this where we are in equities at the moment with this endless consolidation across this very high band of prices. And that is commented on as being a great rotation. Software, as we know, is weak, weak, weak. Other parts of the market are compensating. And we'll talk more about that over time. But this shift, the major break of the sentiment the last few years, when it was thought that AI would be a transformative productivity product to give us a boom, pushing stock prices higher. Well, we've seen all of that, haven't we? And big tech stocks keep rising, sending Meta surging 450% from the end of 2022. Alphabet up more than 250%. The hand wringing over whether it was a bubble about to burst did little to derail the rally. In fact, nothing seems to be derailing the rally. This grand rotation that we're living through in equities is staggering. And you've got Microsoft, Amazon, Meta, Alphabet alone. They're expected to spend more than $600 billion on capital expenditure in 2026. Can you believe that? That's hoovering up all the free cash flows and loading the companies with depreciating assets, radically altering many of the characteristics that have helped fuel the firm's rise over the past decade. And this is a real no-win situation, says a gentleman who's the chief market strategist from Amma Price Advisory Services. Investors are comfortable saying, so long as it happens in the future, I'm comfortable with Microsoft or Amazon or Alphabet spending the money. But now they want to know more immediately when the payback will come. And we don't have a clear picture of that at all. As you know, there's a group of pretty hard-boiled skeptics who are really at the show me the money stage. And it's not clear at all if we will be seeing transformational products coming out of AI that will be transformational in the sense of real market wealth production or creation. So the other big issue that I think needs to be talked about in some detail is this issue of private credit. Now, private credit is huge and it's growing massively. And the market relies on these valuations of assets and liabilities in publicly traded companies. And regulators go to, excuse me, some length to ensure that these balance sheet values are fair and reasonable. I spent many years as a chairman of two listed public companies, and I know the steps you go through to verify your assets and give your shareholders a clear view of what that value is in your opinion and what the risks to that valuation might be. So that's happens in publicly traded companies pretty well, unless they've got assets which are near impossible to value. And this is happening as a huge issue in private credit. Now, private credit has just been expanding so much, but it's very opaque. There's nothing transparent about private credit. And a whole lot of these loans from private credit are engineered in such a way that they're off balance sheet, which is a real problem. And I don't wish to cast aspersions on our regulators, but it's a constant battle. It's a constant battle to keep on top of this question of valuation of markets that are not readily traded. And this whole 2007-2009 market crash was brought about by exactly this, the valuations and hence the carrying values for the various tranches of mortgage-backed securities. You'll remember that. There have been a couple of very good movies about it all. And if you can't realistically value your assets, you are liable to get a bad shock one day. And of course, the problem that is going on inside the works of all these various companies is that the people in these companies who are responsible for promoting the product, for selling the product, for getting money in from investors for the product, they're also very close to the valuation process as well. In some cases, indeed, they are the valuation process. And naturally, they want to preserve and present their assets in the best light. That's human nature. And then what happens, as we found out a little bit today, is what I've been saying to you in the past. If you don't have a true mark-to-market process, we often end up with mark-to-make-believe, which is what it has been in that 2007-2008 period when the securitized mortgages were holding valuations at 100%, and the true value was nothing like that. Interesting stuff. So this is the background which a gentleman has written about in Zero Hedge today. I often talk to you about stuff in Zero Hedge. I like Zero Hedge because they give you information that's not readily available elsewhere, but they don't give you an opinion. And if they do, it's certainly couched in very careful terms. And I often get some of you write to me saying, have a look what this guy's saying, have a look what this guy's writing about. I don't read that stuff because I don't want anyone else's opinion on markets. That might sound arrogant, and it probably is, but I believe I understand markets, and I don't think that many others have a full appreciation of markets as I do. Anyway, this gentleman in particular, he's giving us the background. He's saying, in August, President Trump signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors. This is the savings accounts of American investors, American generally. And the order directed regulators to make it easier for your retirement savings to flow into private credit, private equity, and other alternative assets. The Department of Labor quickly rescinded Biden-era guidance that had discouraged these investments in retirement plans, and they're all racing to launch private credit products for your 401. But here's the problem. Private credit is showing cracks at all the exact moment they want to open it up to retail investors. Well, none of that surprising. That's what those businesses are there for. That's the core of their business, get in other people's money. And no surprise there. The surprise is that, and I guess there's no surprise of Trump giving that order either. He's an impulsive gentleman, and he's a great believer in free markets. And free markets are all very well and good, as long as the players, the people paying the bills, have access to all of the correct information. And have a look at this. Just this week, BlackRock Capital, one of the largest publicly traded private credit funds, plunged 17% after disclosing a 19% write-down on its net asset value, the biggest drop in 6 years. This is BlackRock, the world's largest asset manager, 1.2 trillion in assets. If they're taking hits like this, what chance does your 401 have? It goes on to say, let me walk you through what's actually happening in this market. Private credit has ballooned to over $2 trillion in assets. For years, it was the domain of sophisticated institutional investors, pension funds, endowments, insurance companies. These investors have teams of analysts, lawyers, and risk managers to evaluate complex deals. Your average 401 participant doesn't have any of that. And that's true. And the problem with private credit is, as I say, so much of it is opaque. So little of it is transparent. And when you're asking the promoters or people close to the promoters to value these assets because there's no public valuation process, you're really putting your head in the lion's mouth because they all, being humans, will have a tendency to try and protect their asset, try and protect what they've created. And if that means putting a slightly more rosy view on its value, you can be absolutely sure that that is exactly what is happening. And it may be a bit more than a rosy view. It may be a misleading view. And that's the big risk. And I think it's happening now. And here's an interesting chart from Alpha Returns and saying United States long-short managers are down almost 1% year to date. And coming into this week had lost 200 basic points of alpha return since January 27th. Alpha is just fancy code word for profit. The second worst alpha drawdown over a 3-week period since the first half of 2022, according to Goldman Sachs. So this was the big news today. And Zero Hedge have titled it, "The Canary in the Coal Mine Just Froze, Why Blue Owl Just Gated Retail Investors." Now, Blue Owl is a massive investment, a publicly traded vehicle itself, but he goes on to say, back in November, when following investors' outrage, Blue Owl abandoned its plan to merge its OBDC2 fund. You'll get confused by that. Don't worry about it. It's just one of a number of funds with very similar names. And that particular deal they were running at that time would result in losses as high as 20% for some investors. So CEO Craig Packer appeared on the television and tried to calm fears by saying, there is no emergency here. As it turns out, there was an emergency because, as we reported earlier, Blue Owl Capital, with 307 billion in assets under management, just permanently halted investor redemptions of its retail private credit fund, OBDC2. So it's come up with a complete restructuring plan for this particular credit fund, expected to be completed this quarter. One of the concerns is that the largest industry represented in the portfolio being sold is internet software and services, 13% of the total. More on this below. Dumping software loans may boost some confidence in Blue Owl's balance sheet, but will only inflame concerns about the underlying fundamentals of the software space and how it is funded, and what he neglects to say is how it is valued. And he goes on, after all, with the software sector losing 1 trillion in market cap in recent months as a result of AI disruption fears, any incremental event that de-risked exposure to software is unlikely to be viewed positively by the market. Okay, you with me so far? That's where we are sitting about the things to be thinking about the things to be worrying about. Now, markets, we know, climb a wall of worry, but this issue of non-reliable valuations of private credit assets is a biggie. It's a theme that's been running through the market forever. Go to the 2000 dot-com high. Go to the 2007 S&P high before the crash into 2009. Any major market event to the downside that you can think of has in its element a failure to properly value assets. And this whole private credit game, which is over 2 trillion now and expanding at a massive rate, where do you think all this money is going to come from for all these multi-million, in fact into billions expenditure on building out the data centers for AI? Well, some of it's going to come from stock issuance, some of it's going to come from conventional borrowing, but already we can see the vast majority of the funding is coming in forms that are private credit. So that is a big bogey. We know it's not being valued properly in the case of Blue Owl, at least, and others. The auto companies that went bust last year, some of you will remember, they are just let me something or other. Greg's posting. Thank you, tend to agree with you. We've used Blue Owl, BlackRock, and many others. Too many of these have gone unreported. I think it's all coming to a crescendo. I think that equity markets, which are my particular interest, as you know, have been range bound now for months, weeks and weeks and weeks. It's pathetic. And to me, it's also amazing how they can keep finding new things to do in the equity markets, but holding them above that threshold, which would cause some real problems. And this issue of opaque and non-transparent valuation of assets, as I say, that's been the market forever. There's nothing new about that. All of the big scandals have an element that assets have been improperly valued or are held out publicly to be worth many multiples of what they're truly worth. And that's been going on forever. And that's exactly what happened in the CBD, the mortgage securitization issues in 2007, which led to the crash to 2009. That's exactly what happened at the dot-com top. That's exactly what's happened at every major correction in the stock markets. And I think this one is going to have some profound effects because it's just giving us a view into the tip of the iceberg. And I think the iceberg of private credit is bad. I think it is rotten inside. And eventually that's going to come out. Okay, I'm going to go on now and show you a little bit of what we've been doing during the week with our trading. And if you'd like to learn how to trade the way we do, we have a series of videos called TTT, or Teach Yourself to Trade. This is for us a comparatively recent product. I guess everything's comparatively recent because, as you know, we went public with the Danielcode website in 2007. So everything since 2014 or so is certainly recent for me. Anyway, it's been a marvelous tool, a marvelous teaching tool, and we've had so many people take advantage of it. It was really developed by me as a way of giving you a product that would be more to your liking. You're not going to have to wait around for me to start a lecture for you. You can go through the process of these lectures anytime you like in the privacy of your house or anywhere else. And they're all chopped up into neat little bundles, which will take you through the whole trading process and give you the opportunity to learn as much or as little as you like. There's a link at the bottom of this page, but go to the Danielcode website, www.thedanielcode.com, and you'll find the links to TTT there, and of course our other method of teaching, which is direct one-on-one with me, John Needham. So here we are. What have we been doing in the last couple of weeks? Well, what we've been doing has been a bit haphazard, and there are a few holes in the coverage caused by the fact that I'm having serious troubles seeing charts. And if you could see me crouched over here with my high-spec glasses and a handheld magnifying glass, and one eye's completely shot and the other one's well overdue. He was shot some time ago. But anyway, we've managed to keep going, and we've had a fabulous week or two in Forex, which has certainly come alive with a big bang. So as you would know, we're rather unusual in market commentary and the creation of market signals, because we not only cover a wide range of futures products, we also cover Forex. And if you prefer, you can trade the Danielcode Forex signals. You can trade them in the currency futures with the CME. And the signals are exactly the same. You just got to look up the number, use a buffer of 2 ticks plus and minus, and you can use exactly these same signals to trade currency futures if you like. But this is Forex, and we have a really good core of people who are pretty much wedded to Forex. So I'm delighted to be able to give them a bit more of a showing today. We have been very limited in our coverage of Forex simply because Trade Navigator don't release the data until later in the day, in the evening, whereas I'm putting these webinars together, you know, at 3 and 4 o'clock in the morning. So let's move on. This was the Aussie USD that we're short. This is Euro Japanese Yen. Very nice. We got short of the high. We got long at the low, or close to. You can't do much better than that. But have a look at the scope of these trades. I'm actually going to show you every Forex market we cover except one, which was gone nowhere in a hurry. Have a look at this. This is the Euro US dollar. We were long into the high. We were short from the high in early February, and we just got short for this last move down, which has been 1, 2, 3, 4, 5 days. Got a little bit of a move on today, and look how it's closed below the black line. The Danielcode black line is rather famous, and I've talked about it before, why it's famous, and it acts as a support and resistance like all of the other Danielcode numbers. But the black line is special because a close the other side of the black line, in other words, overcoming the black line, raises the probabilities of a failure of the major swing to quite phenomenally high levels. And those of you who follow our 6-day chart will remember me showing you that we had a failure of the black line in the crude oil on the 6-day chart, and I highlighted the black line that had been violated. It took it 6 weeks to get there, and it got there, didn't it, in a rush. And that was a pretty fabulous short to be trading from the rally after the black line was breached. Nice stuff. You can see here, this market's closed below the minor black line, gives it permission to go further, which is likely what will happen. This is the British pound Japanese yen pair. Same thing, we got to sell right at the high. Little 2 days down, little 1 day, half a day counter trend, and then it went back its way that it should, and we got a decent run down into the buy signal, which we've been on now for 2 days. Let's have a look here. This is the British pound US dollar. Interesting, we had a sell right at the high back in early February, and we had a little rally, and then we got short again at the counter trend high with a 1 bar counter trend in the middle of it. Otherwise, it's starting to show some real pace to the downside. This is the Kiwi. The Kiwi is not pegged to the Australian dollar, but it often works in tandem with it because Australia is the big brother. Australia is by far the biggest trading partner of New Zealand, the most beautiful country across the Tasman Sea, or across the ditch, as we say. It is a wonderful, wonderful country. I've spent many years there and enjoyed all of them. Wonderful place to live if you ever have the chance. Don't be frightened to take it. I say that New Zealand's like Australia used to be 20 years ago, and in saying that, I inadvertently upset everyone. Aussies don't like me saying it, and Kiwis hate it. What I actually mean is that New Zealand is a much freer country than Australia. In Australia, this is the capital of rule by bureaucracy. We have such a huge, huge public service in Australia with bureaucrats, and they spend their life telling you what you can and can't do, and they spend the rest of their life thinking up new ideas that they can tell you what you can and can't do, and it's abysmal. New Zealand has a much more liberal business environment, very, very good. They've also got much better tax rates than Australia, where the tax rates are horrendous. So wonderful country. If you get a chance to go there, jump on it. It's also one of the most beautiful countries in the world. New Zealand and Ireland, just so picturesque, so beautiful, and wonderful, wonderful to have had an opportunity to live in New Zealand, as I have for many years, and plan on going back there. What's more, so this was the Kiwi, up and down, but always at Danielcode price levels, you can see. And those two price levels are published days and weeks and sometimes even months before the markets reach them. This is the dollar CAD, Canadian dollar. This is referred to as the loonie. Traders call this the loonie. The loonie is the native bird of Canada. This pair is referred to. All these pairs have nicknames. You know, the US dollar, British pound is called Cable. The Kiwi is New Zealand US dollar is called the Kiwi. Aussie US dollar is called the Aussie. There's another bird in there somewhere. Which one? Oh, the Kiwi was a flightless bird. I think that they all have their own little names anyway. The Japanese yen pair, of course, is the yen. Very interesting what's happening with the yen, which is still the world's dominant carry trade. If the US dollar weakens much more and the yen starts to strengthen, that's going to have terrible problems for the people who are using it as a carry trade. Thankfully, I don't think that's going to happen anytime soon. I've noticed, I'll show you a chart of the US dollar very soon, and it's found Danielcode support, and it's been sitting on that support for months and months and months, and it seems to be very stable, and it's about 50% of the range. And all of this commentary and hoo-ha about the end of the US dollar, forget about it. Let's just talk. It's not happening. And this is the dollar yen pair right here. You can see same thing. Markets have turned at and only at the Danielcode numbers. They come in blue lines, which are extensions of a range, and the red and black lines, which are retracements of a range. You can see how incredibly accurate they are. I've just shown you pretty much every high and every low worth worrying about on this chart. They've all happened at Danielcode ratios and on Danielcode signals, which we publish every day. I know the rest of the world spends many hours and much news type hailing their wonderful trading results. I don't think anyone's ever had trading results like we have. I just don't go yodeling about them much. Perhaps I should. Perhaps I'm doing myself a disservice. there you are, markets turn at and only at the Danielcode ratios. And this is gold. You can see we had the high right exactly at that blue line, 3628, just a handful of ticks away. And that was a Danielcode correlated sell at that price, because you had also had sell signals in silver as well. That great big bar down, incidentally, Greg, you'll be interested in this. We got stopped out on our trailing stop, but we got stopped out with $16,000 profit in one day. It was pretty extraordinary, wasn't it? Yeah, good stuff. And now it's trying to make up its mind what it can do. This is soybeans, which is a very interesting market, and Jeff's here. I know he's a farmer in Idaho, I think. He's got cattle and crops, and he's had keen interest in Trump's promise that that he extracted from the Chinese, that they would go back to buying more soybeans after the disasters of 24 and 25, when the Chinese really diverted this as one of their standard markets and replaced it with a crop from Brazil. Have a look what's been happening here lately. We had a buy signal run us up from the blue line, which was the low, the turning point. Little correction there that ran us into another buy signal. It's been a little bit complex. It's not as simple as it looks. We've had a couple of stop outs and get back in, but you can see this has been a very, very strong trend, and the angle of attack is getting steeper, which is a good sign. I must schedule at one of our webinars tell you about the angle of attack and how that can keep you on the right side of the market all the time. Okay, so what have we got here? Just let me check. So, Iowa, Jeff, of course, he's right on the ball. And it was interesting to tell us when I was talking about the deal that Trump has done from farmers to give them some relief from the dreadful, dreadful conditions they've had with low prices and no sales in a lot of these products. Jeff was quick to say, well, sounds good, but they haven't given us the money yet. So he's a very pragmatic farmer. He knows what's what, and he'd be happy to see the price of beans is on a pretty steady upward trajectory. It's got a major target. You can all see the previous high. It looks sure to attack that very soon, and we'll see if there's some real relief over China's behavior in this market and the US wheat market as well. Here's silver. This was just beautiful, wasn't it? The Danielcode sell came right at that high. We had the blue line at 12.12.6, and pretty much within a few ticks it hit that perfectly, put in a small key reversal bar, recovered most of that range the next day, and then went whoosh. That is a huge, massive bar, and just super trading. But if you got it, you earned it, because on the way up it was chop, 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 chop. And that, of course, is the way overbought and malpriced, incorrectly priced markets will correct, often with a big, dramatic correction. Here's wheat, Jeff. Same thing, choppy, choppy, choppy. And now it's just put in the biggest bar that you can see on the chart. That's today's trading, and it's just stopped at the Danielcode black line at 569, correct for that little arrowhead you see in the price of grains. That's called a correct, and you can see there the black line stopped this thing completely, but it will have a think about it all, and if we can take out and close above the black line, that means further upward price movement, and I'm delighted to see that. It's some relief, at least for our grain farmers who've been having a terrible time. Here's UST bonds, which is very interesting. We've had a nice long trade up from the first counter trend all the way up into the blue line, and the line before it was one of our red lines, which I can't even read today, but I think it's 118 something. Pretty much stopped this market dead. 2 days down, little key reversal bar back up today. Going to be interesting if it can expand on this rally, which is telling us that interest rates should be easing. We're not seeing any notice of that in Australia, where inflation is starting to roar again due to the total ineptitude of our government that doesn't believe extravagant spending has any input result to inflation, which of course is a fantasy. Inflation is alive and well and booming in Australia. I suggest the same thing's happening in the States, and there will be a reckoning because there always is. This, folks, is the US dollar index. This is our long-term chart. In fact, this is a very long-term chart. Each bar on this chart is 59 trading days, which is an unusual number. We usually don't go past 24 trading days, which is equivalent to our monthly chart, if you like, a Danielcode month. Most months are 22 trading days. What I've done here is I've doubled the number of price levels inside each bar. So every bar here is composed of 59 daily bars. And it gives us an option I wanted to show you of the huge range between the 2001 high, the historic high there, and the 2008 low. And this market is sitting at pretty close to 50%. And you can see this last correction, which we've talked about at various times, the last 1, 2, 3, 4 bars have just been bouncing off those Danielcode numbers. And there's a red line there at 95.035. And there was a blue line just a couple of ticks lower, and they combined to make a pretty strong case for support. And that's exactly what you've got there. So this market has a high probability of rallying from this level. I don't know, I never have a view, nor do you, on how far it'll go, but as long as it's holding these pretty strong support levels, that's good. So it's holding itself pretty much in the middle. In fact, today's close is the same as it was in June 2015. So you can see how stable this market's been. So all this talk about the dollar's crashing, the dollar's got absolute rubbish. Put your money in the US dollar. I do all the time. Here we are. Okay, so we got next for you. What we've got next for you is a free trial. If you haven't already used it, made yourself availed of it, please do go and have a free trial of the Danielcode. There's a lot to learn there, and just go to the website, www.thedanielcode.com, to start your free trial. Just hit the register button and follow the prompts. Any issues at all, contact Terry at support@thedanielcode.com. And you should be looking at our TO3 and TO3 plus trade signals, which we publish every day. And as you can see, we're pretty much always on the right side of the market. That's one of the most valuable things about Danielcode. It keeps you on the right side of the market. So any surprises tend to be surprises with the trend, and that can be of big benefit to us, like the wheat trade today. Really, really nice, wasn't it? Okay, and that's basically what I have for you this day, folks. And all that remains is to show you our disclaimer, which basically says, don't risk trading real money on futures or Forex markets or any derivative market until you are absolutely sure that you are a safe and competent trader. And to become a safe and competent trader, contact me. I'll be happy to teach you either personally or through our TTT video series. The good news is that once you are a safe and competent trader, you can make a whole lot of money very, very quickly in trading futures and forex because they're highly leveraged. And it's a wonderful, wonderful way of life, I can assure you. So that's me for today, folks. I will look forward very much to talking to you at our next webinar in another fortnight. Greg knows what a fortnight is. It's not a term used in America, so it was a bit of a mystery for a while, but his son worked it out. I think that a fortnight, it's an old English expression, and it means 14 nights or 2 weeks. Okay, that's what it is. Okay, my friend, thank you. Jeff, that's wonderful of you. Wonderful. That's me for today, folks. Have a wonderful weekend. I will get the signals for today done in the next 40 minutes. So don't forget to go and pick those up because we are having some pretty wonderful trading at the moment and you're part of that. Any particular questions, folks, that you'd like me to answer, please just drop me a line, jneedham@thedanielcode.com. Let me know what you're interested in and I can prepare something to talk to you about at our next webinar. So for now, thank you for being with me. Have a wonderful day's trading tomorrow and enjoy your weekend. Bye-bye for now.